Good morning, Vikas. How are things?
Not bad. Thanks for having me, Nikunj.
So, what is your advice to two category of clients? A first timer who's missed the rally completely. I mean, why would anybody miss it? But there are folks who miss the rally. What is your advice to the first category, and what is your advice to the second one who's participated in the rally? That is it time to stay put or take some profits off the table?
Well, I think it's what has been good is the rally has now given us some breathing space. So we have this proprietary kind of sentiment indicator called India Bull Bear Index. It has worked very well. It kind of around the lows of March gave us a point where everybody was very bearish and we became quite positive on the market. And sometime in the middle of July, it kind of turned pretty extreme, and that's when we started trimming risk. Now, once it goes to one extreme of being super bullish in terms of sentiment, we do not know how that sentiment will adjust itself back to a more acceptable level. That can either happen by a sharp pullback in the market, or it can also happen like it seems to be happening this time by sideways kind of small pullback and a long duration where the gains are getting digested. So, I think it's one of those things. We are in a world where, there is, honestly, it things can turn either ways. It depends on how the market looks at data. Because more or less, we are getting to the end of the hiking cycle. That's more or less is something which the market needs to get convinced about. I think the upcoming Jackson Hole speech, as well as the next the Fed meeting in September, should maybe convince the market that most of the hikes are now in the back, and there are unlikely to be more hikes. Once that is done, then is this does data really worsen, or does it keep on kind of showing that we are not slowing down globally in a very material fashion? If that is the case, then I think markets are likely to take the thing, take the situation as the glass half full, and perhaps we could have a further surprise rally. If that is not the case, and commonsensically speaking, Fed is trying to unravel excesses of over a decade. It's tough to imagine that that can happen without things getting broken. But so far we do not see anything major which has got broken. If the market starts getting worried on that side, then that is where we could have a deeper correction. It's really the two of them. A gun to my head, I think both will happen, but it's just the order in which it might happen. Markets might initially get more okay, that growth is pretty much controllable. It's not really slowing down materially. And later, there could be disappointment on that. So, I mean, in the interim, we could have a broader participation of the rally. So, that's how I think it could play out. But this is a very tough one to call. So clearly, one needs to have a kind of one of the hand on the exit door, even when they want to kind of keep on participating in this rally.
So where is it that you're feeling valuation discomfort, given that in your recent note you've highlighted that the recommended downgrades exceed the upgrades even though the earnings estimates were lifted?
Yeah, that's a very interesting thing which has happened in the last quarter, that it was firstly a good quarter when it came to earnings. Not only what results were reported on the first during the quarter, because I mean, no matter how I slice and dice it, overall universe, even adjusted for oil marketing companies which had pretty big moves on a YY basis, earnings came out to be pretty resilient and stronger than expectation. But however, this is largely happening in the midst of that July rally that we were seeing, and it appears that analysts were somehow feeling like a lot of this is in the price, and our analysts, surprisingly, we had of over well over 100 stocks that we kind of prepared results for. Almost 14 companies were downgraded and only 2 were upgraded. That's a pretty big chunk that we are talking about. That's over 12-13% of the stocks getting downgraded during the result season. This is despite the fact that this was the first quarter where, after 5 or 6 continuous quarters, where during the earnings season, we saw consensus downgrading numbers. This time, consensus ended up upgrading numbers. So there was possibly some kind of discomfort that the incremental upsides do not look large enough for for analysts to kind of continue thumping the table on big buys. I think on that count as well, a little bit of a breather, which we've been having for the last 4 or 5 weeks on the large cap side of things, clearly should be, kind of helping everybody think through all of this, because there are two ways to look at valuation. Now, this is what the analyst did on a bottom up basis. On the top down basis, see, we are not really, I would say, we are not ultra stretched. I mean, it's not eye popping. However, we are not super comfortable as well. So if you were to look at things like where our PE is, it's now gone below one standard deviation to historical average. If I were to look at even simple bond and earnings, bond and equity valuation relative basis, even that seems to have kind of, become a bit more, it still has some room before it gets into the danger zone. So I would say it's manageably stretched on a top-down basis, but there are pockets which one needs to be more careful about. So that's how it's going to be a more stock picking kind of a market.
Okay. So let's start looking at large pockets here. And if one looks at the banks, even though it's turning out to be a good year for equities in general, both locally and globally, banks have just hugged on to the flat line. Good numbers, consensus bullish view, growth is there, and the outlook is also decent. And flows are also good on a net basis. But the sector of choice has become the real laggard in last couple of weeks. Why is that?
Yeah, I mean, that's a pretty relevant question, Nikunj. So I think what has happened was over the last few months, I mean, RBI's last hike was somewhere around February, if I remember correctly. Then the April meeting gave a sense that are we getting closer to a cut? And that's when we saw yields also cooling off. Now, I think the narrative on that could start changing, in the coming weeks. And if you were to even look at today, we have, in the on the monthly economic report that has come out, there is some sense of being more careful because of inflation. I think my personal opinion is that we are in a longish pause and a rate cut may not be imminent. I think the market has not taken an opinion on that. And if market concedes and agrees to my opinion, then suddenly the nervousness on banks will also come down, because if we get into a rate cutting cycle, then that's where you get a bit more nervous and saying that names could contract more aggressively. But if we are in a longish pause, then the impact could be more manageable, given that right now there are no asset quality worries in any significant way. So I would say that around February, March, people started getting more convinced that we are getting closer to a rate cut. I think there is a little bit more equivocal debate around that, on whether there is going to be a rate cut soon or not. Soon, I think perhaps we will move to a situation where markets will start believing that this will be a long duration pause. If that is the case, I think banks will be back in flavor. And that's why in the India focused portfolio that we run, we have banks as one of the key overweights other than energy.
Because when you speak to your clients, some of your peers and some of your counterparts, what is the sense you're getting in terms of the liquidity outlook? Because, time and again, we go back to that same comparison, India versus China, China versus India. China was attractive, China will be attractive, and China will remain attractive. India was expensive, India is expensive, but will remain expensive. Then why do we debate this? Because this is history and this is future.
Sure. So, Nikunj, I think the reason is that China is still a pretty big market. And I think the debate is obviously that will China be able to do something more meaningful to be able to attract, to be able to kind of change sentiment over there. Sentiment towards India and compared to what sentiment is towards China, it can't be more divergent. I mean, people seem to have completely given up on China. On the other hand, sentiment towards India is super positive. But that is also in a way reflected in valuations. I mean, China is very, very attractive on a valuation basis, but that is versus history. And a lot of people argue that that's not relevant. So something I think and we've had, I think this will be the fifth or sixth month of continuous positive flows from foreigners. And what has been very encouraging, particularly for the month of July that we looked at, that a significant proportion of flows that came into India were through India dedicated funds. So in fact, India dedicated foreign funds make up only 6% of the total FII AUM. However, they contributed 40% of the FII inflow that came into India during the month of July. If sentiment towards China doesn't change, we are now seeing money coming not through the EM basket. Now imagine 94% of the FII AUM still is not India dedicated. That's either EM or some global fund, etc. So there's not really investors putting directly money into India. That could start changing, and that, I think, anyways, is the longer term story. Has that started happening is the question. But clearly, I think what's difficult to predict is what will be the Chinese policymakers, what will they be doing? And I think all eyes will be around the time when rains are over, that is in the last quarter of this year, if there is something more significant as a stimulus. Because if that happens, then even the color of stocks which start doing well in India will change. And perhaps India will not outperform if there is a more believable and large stimulus, even though it might have absolute upside still for India. But we need to be careful. If that happens, then a lot of the stocks that are currently not been doing well, like things in the commodity space in India, could start doing much better. So I think that's really going to be a crucial thing to watch out for, even from a global perspective, and will also have an impact on sentiment on India on a relative basis. So, maybe sometime around October, November is when we should be looking at that more closely.
Morning. What about the outlook when it comes to the rural theme? Do you believe that it has already played out, or that there is still a lot more promise when it comes to rural stocks, especially when it comes to their financial metrics?
See, I think at this point of time, we still do not have conclusive evidence. We've had some positive commentary by companies in certain pockets here and there, but nothing positive in the sense encouraging, I would say, but nothing very conclusive that says that rural, as a theme is back and is kind of now improving. Now, I do hear a lot of people drawing a parallel that going into the election period, typically rural should do well. However, what I would, want to also nuance that by is that, yes, I mean, historically that might have been the case. But if you were to look at earlier governments, none of them in the more recent past have been so supply side focused in their policy making. There's been very limited demand side measures that the government has done. Even the recent budget did not have a lot of direct demand side measures. So is this election period going to be similar like other election periods and could have short-term relief for rural? That's something which I would not want to simply draw a parallel to earlier election periods, given this difference, which is a clear, important nuance to focus on. So I would say, I still do not have any conclusive evidence to kind of give you an answer either ways on that one.
Far are we away from a real bounce in IT? The world is divided on old business, new business. What is your understanding?
Yeah, I think so. IT and banks is clearly the two things that you need to get your calls right. Otherwise, it's very tough to outperform. Luckily, we've been a bit lucky in getting that call right over the last 2.5, 3 years. That's why our India focused portfolio has done pretty well. I would say I am still in the camp that the recent recovery that IT stocks have seen will have now again taken their valuations to levels which are not very attractive as compared to that. The other large sector, which is banks, is something where valuations are in general attractive compared to that sector. So within the two, I still prefer banks. For IT, I believe, it's just a long derating period which started with early 2022. And just to kind of remind you, at that point of time when valuations went to +3 standard deviation to historical average, that was a point when everybody thought that this sector has changed forever after COVID because technology has become so important, etc., etc. And when something becomes so expensive one way, the derating period can also be, particularly when we have very good quality stocks. They don't really collapse in a matter of months. The derating period generally is longer, which involves correction of multiples. Yes, a few of them have become a little bit better in terms of valuation, but the sector in general, I think, is still not attractive from a simple valuations perspective.
All right, good to have you. Thanks very much, Vikash, for sharing with us your outlook on the markets, individual themes as well that look promising.